I'll go ahead and get started then. This is Robert Smith with Friday Eldredge and Clark, and want to welcome everyone and thank you for participating today. We are definitely in uncertain times, and it seems to be made worse with the Paycheck protection program, the uncertainty surrounding that. So what we have done really since mid last week, when things were kind of crystallizing as far as what the program might look like, we have spent a significant amount of time, obviously, in the legislation and the limited guidance that came out a day or two ago from SBA, working with our bank clients and then our borrower clients that are folks that intend to borrow under this program to try to understand and better understand really what the parameters are, what works and what does not. And so that's what we plan to do today. I want to introduce also Katie Campbell, who's in our litigation group in our Rogers office, and then Blake Lewis, who is in our mergers and acquisition and corporate group in Little Rock. We have worked very closely with one another over the last few days and working with clients, as I said, to try to get better answers to everyone. As we have, as we've experienced this, I think there are more questions than answers in a lot of cases. But the materials we have prepared today will be, first of all, just a review of the program and some of the nuances that we've been able to discern as we work through the legislation, as I mentioned. Focus also on the forgiveness aspect of the loans, and then to talk through what I hope will be helpful to everyone, just the things we see as the main open issues or uncertainties, and kind of the questions we're hearing the most as being problematic. And then just to talk through just frequently asked questions that we're getting from clients over and over again. We'll probably send something out on those as well when we're able to have time to do that, just to try to clarify some things. But with that, I'm going to turn it over to Katie, and she's going to start just walking through things, and just keep going there, Tabitha, on the slides, if you will. And just let me say, there is a chat function, and hopefully we'll have access to that. But if anyone needs to submit a question, you're able to do that as we go along. And if we're able to access those, we can certainly address those. And Katie?
Okay. Thanks, Robert. Good afternoon, everyone. This is Katie Campbell, and as Robert said, I'm going to give an overview of the Payroll Protection Program, kind of a high level. So just a reminder of how we got to where we are. The CARES Act was signed into law by the President last Friday. Sometimes it seems like a year ago, not a week ago, but it was just last Friday. And that was a $2 trillion stimulus bill, basically designed to get Americans through the next 3 months of this COVID-19 pandemic, passed with broad bipartisan support. There's a lot in that bill, but for today, we're just going to focus on the Payroll Protection Program aspects. And that specifically was a $350 billion program designed to keep workers on companies' payrolls over the next couple of months. So the first question is, who's eligible to receive a forgivable loan under the Payroll Protection Program? The only criteria for that are, one, that the business concern has fewer than 500 employees, two, the business was operating as of February 15, 2020, and three, the borrower had employees who were on the payroll as of that date in February. So it really expands the definition beyond who would ordinarily be eligible for an SBA loan. So the Act specifically includes nonprofits, including 501c3 organizations and veteran organizations with fewer than 500 employees. And it also includes self-employed individuals, sole proprietors, and independent contractors. The program also would include any business who would otherwise meet the SBA's standards for a 7A loan. And when you're looking at that 500 employee threshold, you use the number of full-time and part-time employees during the covered period. So that would be in February 15, 2020, until the time you're applying for the loan. There are a few limited exceptions to the 500 employee limit. So for the accommodations and food sector and for franchises, they are accepted from that limit. So basically, if a standalone location of one of those businesses has 500 employees or fewer, then they would apply. And finally, the usual requirement that a business is unable to receive credit elsewhere has been waived. So that is not a requirement to receive the loan either. So the next question is, what are the loan terms? Now, some of this has just recently come into focus with guidance out from Treasury over the last few days, and we expect that more possibly could be coming later this week or early next week. But what we know now is that there's no collateral or guarantee required during the covered period, and the bill defines the covered period as February 15th through June 30th. The portion of the loan that is not forgiven, it will bear a 0.5% interest rate over 2 years. And loan payments, including principal, interest, and fees, will be deferred for 6 to 12 months for borrowers, and that would be starting at the date of the loan origination. And they're 100% backed by the government. And finally, there are some processing fees that are based on the balance of the loan at the time of final disbursement and based on the loan amount, and those range from 1 to 5% depending on the size of the loan. In terms of how the money may be used, the Act specifically says that the money can be used for payroll costs, mortgage interest payments, rent, utilities, group health care benefits and insurance premiums, and to pay interest on any other debt obligations that would have been incurred prior to February 15, 2020. And as Blake will explain next, not all of those reasons are forgivable, but all of those are approved uses for the funds. Borrowers also must make certain certifications about how the loan proceeds will be used, and Blake's going to cover that as well. So in terms of calculating the loan amount, what is the maximum amount that someone can borrow? To calculate the loan amount, you take the business's average monthly payroll during the 1-year period prior to the loan being made and multiply it by 2.5. So the maximum amount that someone can receive is $10 million using that formula, but it really looks at payroll amounts with that multiplier. Now, for businesses who are not operating prior to June 30th, 2019, as opposed to going back a full year, you would look just at January and February 2020 payroll, and there is a different calculation for seasonal employers as well. So the calculation seems fairly straightforward. You just multiply payroll times 2.5, but the definition of payroll is somewhat more complicated. And I think that's really the $64,000 question right now is, what and how is payroll determined? And the way the law is written, I think as Robert will kind of go into in more detail, there are a lot of questions about this. I think the question is important too, because payroll costs are used to determine the size of the loan, but they're also used to determine the amount that is forgiven. So bankers and borrowers alike are going to want to be careful when determining the payroll costs on the front end to make sure that there aren't unexpected amounts that may not be forgiven on the back end. So I think the definition of payroll cost is one of the most important aspects of this. So as defined by the Act, payroll costs include salary, wages, or commissions, payment of tips, payment of vacation or sick leave, severance type payments, retirement benefits, payment of healthcare benefits, including insurance premiums, payment of state and local taxes assessed on employee comp, and then payment to independent contractors. So probably equally importantly is what is not included in payroll cost. Employee compensation is capped at $100,000. There is a nuance in that the Act basically says that the annual salary is capped at $100,000, so it's somewhat unclear to whether an employee's wages would be capped at $100,000 and then other benefits could be added on top of that. I think we've determined that the most prudent approach is to cap it completely at the $100,000 level, but I think Robert will go into that in more detail. And there are also some questions about what kinds of payments to independent contractors should be included in the payroll determinations that Robert will address as well. You also would exclude the employer's share of payroll taxes from the payroll totals, and you would exclude any wages that are paid under the recent Families First Coronavirus Response Act, paid sick leave. So that act passed a couple of weeks ago, provides for paid sick leave and paid emergency family medical leave, and that paid sick leave will be covered by a separate tax credit, so you would exclude wages under those sick leaves from your payroll costs as well. So I'll turn it over to Blake now.
Thank you, Katie. Like she said, I'm going to be talking about the forgiveness provision of the the Payroll Protection Act. But before I do that, I want to talk a little bit about relief for existing SBA loans. Now, this wasn't part of the payroll protection provision specifically. It was in the broader CARES Act. But since we're talking about SBA loans, I thought it was important to mention this on the front end. So under the CARES Act, existing SBA loans are eligible for up to 1 year of deferral. In addition, the SBA is required to pay the principal, interest, and all associated fees for 6 months, beginning with the next payment date. So what this means is that if the borrower elects to defer the loan, then the SBA will begin making payments on the loan at the expiration of that deferment period. There's also been a lot of questions about how the payroll protection loans work with the EIDL loans. There's a lot of uncertainty right now as far as how those two work together, but there are a few things we know, and one of those is that the forgivable portion of the EIDL, which is $10,000, will reduce the forgivable amount of the Paycheck loan. And that if you take out an EIDL to cover costs other than payroll costs, rent expenses, or mortgage interest expenses, then you can still apply for a Paycheck protection loan. Now, whether you can apply for both loans to cover payroll and mortgage interest and utilities is still being debated. So we think the safe route would be to limit your EIDL loan proceeds to cover things that aren't mortgage interest, utilities, rent expenses, and payroll. One important aspect of the payroll protection provision is that a borrower can refinance the EIDL into a Paycheck loan and receive the loan forgiveness on the refinanced amount. So each payroll protection loan is eligible for forgiveness, but only to the extent that the proceeds are used to cover rent, utilities, and payroll costs during the first 8 weeks of the loan. So any dollar you spend after the first 8 weeks, regardless of what it covers, is not going to be forgiven. And so once you determine how much of that money was used to pay for rent, utilities, and payroll costs during the first 8 weeks, you then have to reduce the forgivable amount if you laid off or furloughed employees, or you significantly reduce the compensation of any one employee. So if the borrower furloughs or lays off employees, then the amount eligible for forgiveness is going to be reduced in proportion of the reduction in full-time equivalent employees from February 15th to June 30th, as compared with either at the election of the borrower, the average number of full-time equivalent employees per month during 2019, or the average number of full-time equivalent employees per month during February 15th of 19 through June 30th of 19. And this calculation is going to be different for seasonal employers. So just for sake of example, if the borrower employed an average of 100 full-time equivalent employees per month during 2019, but only employed 25 full-time equivalent employees per month between February and June of 2020, then the amount eligible for forgiveness is going to be reduced by 75%. However, there's an exception to this rule, and this is if the borrower eliminates the reduction no later than June 30th of this year, then that reduction will not apply. So in my previous example, where the employer employed 100 full-time equivalent employees and then reduced his workforce down to 25, if he were to rehire all of those employees on June 29th of this year, then he would not have to reduce the amount eligible for forgiveness. And a lot of people have asked me this, but you don't actually have to rehire the same employees. It can be, they don't look at who was hired prior to the layoffs versus who was hired after. You just have to have the same number of employees. And in applying for loan forgiveness, the borrower is required to make a couple of different certifications. And one of those is that the documentation that he provided to establish the forgivable amount is true and correct. and the certification that the amount for which forgiveness is requested was used to retain employees, make mortgage interest payments, rent payments, or utility payments. If you look at the current loan application that's circulating out there, it adds some additional language to the second certification, and that is that you anticipate that no more than 25% of the forgiven amount may be for non-payroll costs. So this language isn't in the act itself, so there's a lot of speculation as to whether the forgiveness amount is going to be limited to the extent it doesn't cover payroll costs. We don't think that it will, because that's not what the law says, but this loan application has definitely raised the issue. And I think I'm going to kick it back to Robert.
Okay. You hear me okay, Tabitha? Good. Hey, can you hear me, Tabitha?
Sorry, yes, I can hear you.
All right. Go to the next slide there. Okay, and so so Blake and Katie, appreciate that. And so that a review of just a lot of the provisions that I'm sure you guys have had been having questions with clients or customers from over the last few days. From a lender's perspective, you know, we have had, as I said, we've had a lot of calls with banker clients and a lot of calls with borrowers. From the lender's perspective, more, you know, the things that are still raising questions and considerations, primarily the interest rate issue, which I'm sure you're all well aware of. So the Act provides for a maximum rate of 4%. Most banks that we had spoken with regarding this intended to price it around 4%. And Treasury came out, or SBA came out with a 0.5% as a maximum, just uniform interest rate. There was significant pushback on that, as you're aware, I'm sure. Our word was yesterday, I think that French Hill and some other representatives and senators were meeting with Treasury yesterday afternoon. At least as of 30 minutes ago or so, I have not received any information regarding the results of that meeting. And it's really unclear at this point whether there will be a modification to that guidance from SBA. We have had several of our smaller bank clients that have indicated they do not intend to participate in the program but because of that. And I think many others have indicated that they would prefer not to participate in the program, but they feel compelled to do so given the customer demand and really the intention or the expectation that they would be able to maintain that customer relationship a lot better if they participate in the program and provide the loans. So we're seeing a lot of reluctance, but willingness anyway for banks to participate. The feeling of being overwhelmed with applications, I think, is across the board what we're hearing. I've had a call earlier today with a client of ours regarding how they will handle the internal approval process, given that there is such a limited underwriting sense on something like this. And so what they expect to do, I believe, would just to have a blanket approval, more or less, within executive management for approval of these paycheck protection loans, and then just have weekly reports or some other periodic reports to directors as far as the amounts. If a bank chooses to participate, they can obviously back out and remove themselves from any further participation with new loans at any time. So we are seeing a lot of discussion around that right now. The question we get from a lot of bank boards that we've had calls with the last few days are, what are the risks of the uncertainty in something like this? And as was mentioned earlier, the problem is in the ambiguity. Well, I think it's two sides. It's in the ambiguity within the legislation itself that was passed, and then the limited, almost laughable guidance, in my view, of what we received from the SBA. As Blake mentioned, the application and those information sheets include things that are not even in the Act, that it's unclear if it really is something we have to abide by or not. So Most of that, though, as Katie mentioned, is driven. The ambiguity is driving problems through the payroll cost definition. That definition drives everything. It drives the loan amount. What we're telling clients, it creates the risk if you get it wrong that you have made a loan in excess of the authority in the act, thereby potentially ending up in a situation a few months down the road where you're told that you have a loan that is say 80% guaranteed, but you made an excess loan because the payroll calculation was incorrect. Two of the main issues there, excuse me, with the payroll cost calculation come in this language with payments to independent contractors, because you can, in good faith, read that language to say that an operating business that has employees, if it also makes payments to independent contractors, that those amounts are also included as payroll costs. Now, we think that's a clear reading of a plain language reading of the statute. We don't think that was intended at all, and think it's unlikely that SBA would go along with that. But you kind of get in a position where we're talking with our borrower clients, and they want to include every payment to an independent contractor. And then we're talking to our bank clients and advising them to be obviously very conservative in how that calculation is made and how that is read. There's been a lot of back and forth that we've had with other attorneys around the country and CPAs just to get different interpretations of that. I would say that in a number of cases, what I would expect you would see is that if a company, for example, has independent contractors that are doing the same work as employees, which you often see, maybe outsourcing a bookkeeping function, or you may have employees who are salespeople and then also use independent contractor salespersons. I think you will see a lot of situations where the borrower will sit down with their accountant and they will calculate a payroll cost amount that includes those types of independent contractor payments. The more abusive it would obviously be if they were including payments to a law firm or an accounting firm or something like that. But that is something definitely we're advising bank clients to be on the lookout for. We think the more conservative approach is the better one, so just be aware of that. The $100,000 cap amount is another issue that is still open, and as Katie mentioned, the reference in the statute is to annual salary. And so it brings up the question about bonuses or commissions, retirement benefits, other benefits that are paid. We have internally decided that the prudent approach is to advise that the most likely intention of the act, despite how it's worded, is that the $100,000 is a cap on salary, wages, that type of just cash compensation, but that other benefits could take the total pay in excess of $100,000 and still be included. One thing to note there is if you had a payment that is based upon based upon total pay, like a retirement plan contribution, we believe the best approach would be to prorate that to the extent of $100,000 of total compensation. So just again, that's the best guidance we think we can give. There's been obviously no clarification of that from SBA at this point. Another aspect of the payroll cost definition is the treatment of employee income tax withholdings, because the way that it reads, the section just below the $100,000 cap deals with exclusion of several types of taxes, one of which is income tax withheld on employees. So you get into the question of do you use a net payroll amount for an employee versus a gross payroll amount, which would include the withheld income tax. Again, we think the best approach and the likely intention of the act was to not reduce employee pay by the amount of income tax withholding, so that those would be included in the number that is applied to the 2.5 multiple. So those are thoughts on that. Katie or Blake, did you have any other thoughts on on those issues?
No, I think that you summarized the issues well.
Okay, and we've probably had, I think you guys would agree, we've probably had more questions just on what is payroll cost than anything else. And
yeah, absolutely.
yeah, another uncertainty we're running into, which I'm sure many of you have had this come up, is whether or not churches can participate. And so religious organizations are specifically excluded from participation in SBA loan programs under an existing regulation. The question comes up, though, that the CARES Act makes nonprofit organizations eligible for the Paycheck Protection Program, and then it refers to or defines a nonprofit as any organization described in Section 501c3. So churches, for income tax purposes, are deemed to be described in 501c3. So it's really uncertain whether that old exclusion still applies for purposes of this Payroll Protection Act. Every church that we represent or talk to intends to apply for the funding, and so banks will have to make that decision. I would think that would be something the SBA could confirm easily, but I'm not sure we will get that. We have had, I think, some banks that have said they would not accept those applications just because of the uncertainty, which makes sense at this point. So all of kind of the ambiguity we're dealing with, and the program, as you know, is moving at light speed, and it concerns everybody, I think, at this point. So we've been working with clients on ways to mitigate some of this risk as best we can. And I don't think there's a perfect fix short of governmental guidance as to what these things really mean and how they should really work. But what we see, and I'm sure you all expect, we do not think it's realistic that the SBA is going to give a green light on every loan and every payroll cost calculation. That's just not going to happen. So to try to reduce some of the risk, we've talked with clients about a couple of things. First of all would be you're aware that the legislation does not allow for personal guarantees, and it's stated that these loans are non-recourse to any individual owner or partner or whatever of the borrower. But we have talked to clients about indemnification provisions, and so that would take the form of having the borrower sign a certification to the bank, not to SBA, but to the bank directly, that the calculation of payroll costs was made in accordance with the provisions of the CARES Act, that it's the borrower acknowledges it's their responsibility for the calculation, and then agrees to indemnify and hold the bank harmless to the extent that's later determined to be untrue or incorrect. That's not a personal guarantee. It's not pledging collateral. It's simply a contractual obligation that the borrower would have. We believe those are enforceable, and they're clearly allowed under the plain terms of the Act, and should not cause a problem. The other aspect of this would be a bit more controversial, but wanted to make you all aware of it. The Act says that no personal guarantee can be required, but it says that no personal guarantee could be required during the covered period, which is the period ending on June 30th. And so there are some banks we have spoken with that have expressed an intention to provide language in their loan agreements or in a side agreement that would require a personal guarantee to be provided at some point after the end of the covered period, which is June 30th. Again, technically under the terms of the Act, that would be permissible. We have concerns about how practical that would be, whether a borrower would certainly probably be more likely to walk across the street to another lender that is not requiring that. But just something to give some thought to. We are completely comfortable with that interpretation, but it may be something that's not practical to implement, again, given the speed and the willingness of other banks to step in for the borrower. But the indemnification provision, I think, is certainly something every bank should consider, and I don't think we would get much pushback from borrowers on that. So those are just some things, kind of some open issues that we're still seeing. You all have, I'm sure, looked through the loan application that Blake talked about. There is you'll see in there, I think item 3, it is a requirement that there be a disclosure of affiliates. And so just so you know, I mean, we are advising folks that under the affiliation rules that the SBA has that have been around forever, You're looking at 50% plus in voting equity as far as common ownership test, as far as who would have to be or what other entity would have to be disclosed. And then typically a majority overlap in managers or directors between the borrower and some other entity. Those would be required to be disclosed. We have gotten questions quite a bit about certifications that are required and whether there's a financial need requirement or anything like that. Some uncertainty, and I guess some clients uncomfortable with on the borrower side with being able to make any type of certification regarding need for the money or for the funds or anything like that. We're comfortable that the intention of the act and language in the act is pretty clear that the SBA is assuming everyone is impacted by the virus and by the economic uncertainty. So we don't really see any risk there for a borrower. Blake mentioned the 25% requirement in the application. Again, it's not required under the law or not a provision in the actual law, but it shouldn't really, I wouldn't think, cause a big issue. Most clients should be able to meet that without any problem. And so those are the main issues, kind of the uncertainty that we're seeing. Hopefully, I think what I read this morning, we are expecting that there would be some type of interim rule issued by the SBA today or tomorrow that would provide clarification on what the bank's obligation is to verify information, because right now, I mean, it's really a self-certification, and I think it will end up just being that on the borrower side, unless you have some reason to believe you're being misled as a bank, then there's not a separate independent audit of their payroll calculation that you could do other than just looking at normal information that a borrower would provide. So those are the main issues. A handful of other things, we've kind of internally kept a running list of frequently asked questions that we're getting, and so I'm just going to throw a couple of these out there, and Blake and Katie, just chime in if you have a thought on these or anything. One thing we've looked at and had questions about is whether related entities should file a separate loan application or a single loan application. And it's clear that it's this is driven by payroll. So if you had a parent and a subsidiary entity and they each have a separate payroll, then they would file based on whatever their payroll numbers look like, but would file a separate application there. We've had a common question about deferral of pay. And so we've had clients that have reduced pay for employees in the last few weeks and told the employees they are deferring it till later in the year. So the question comes up when you get the Paycheck Protection Loan, can you then pay back pay with those funds? The language in the forgiveness section refers to it says cost incurred and payments made during the 8-week period. So I think technically you could pay back pay to an employee. It's clear, I think, in the legislation. It's one of those things, I'm not sure that's what the SBA has intended for this, but that is something that I think you could do. We've had a lot of questions from clients about the utility service definition. So there's as Blake mentioned, on the forgiveness side, and really on just the use of proceeds side, utilities is a permissible payment. One of the utilities that is listed is internet service there, and so several clients in the healthcare area have asked the question about the enormous expense they have, and certainly banks would have to, but with data storage and security, data interchange costs, that sort of thing, whether that is encompassed within internet services. We have spoken with French Hill's office about that, and actually with French Hill about it, and he was going to take it to the SBA and see if we could get any type of relief there. I don't anticipate that we will necessarily, but just something to keep in mind. Probably most common question that we are getting is related entities, and with small businesses that pay a related landlord, for example, or had an existing debt with a related party that existed as of February 15th, whether those types of payments on the interest or the rental payment would be acceptable. And There's nothing in the act that would prohibit that. The affiliation rules are waived in some situations, as you know, but none of those anyway would come into play with respect to the use of those payments and to the payment to a related party, provided that again it existed as of February 15th. And then just one final thing to point out on the forgiveness side that Blake talked about, the law is pretty clear at setting forth the things that a bank and a lender is required to look to and to verify in making that forgiveness determination. So that's something to take a look at as far as how loans funds are used. We are advising clients to set up a separate account to accept the funding and then to disperse the funding from that account. I had a client raise a good question about payroll and not wanting to have to run payroll through a different account. I think as long as if you have a single payroll account you use now, as long as the initial funds are placed in this new separate account and payroll is drawn from that as necessary, I think that would be the best thing to do. That separate account would give the clearest indication of how funds are dispersed under the loan. I think that's all we had. Katie or Blake, unless you guys had anything else to add.
No, I don't have anything.
Okay.
No.
Well, we appreciate everybody. I do not see any questions popping up on the chat, and so that is all we had. We appreciate everybody participating. We are available, our phone and email and all that. And as Tabitha had shown on the screen earlier, we are continuing to update the guidance as we know more. We're making sure our clients and our folks we have contacts with, we're making sure that we get information out to everybody. And so we would be happy to visit if anybody just has a